How to pick great stocks, the most common question. And today I'll show you step by step how to select great stocks. So without wasting any time, let's dive right into it. Day traders use technical analysis for short-term price movements, but today I will only focus on fundamental analysis. The first step is you choose the company that you understand well. So what do I mean with that you understand the company? First is you need to ask yourself is what does company do? So for example, let's take Apple and McDonald's. Apple makes iPhone, they make iPads, they make many cool gadgets like AirPods and Apple Watches. They also make money by selling their iCloud services and Apple Music. And think about how many people you see every day using iPhones at your work and at public spaces. So that's how popular they are. Now, if you look at McDonald's, what do? They are one of the most famous fast food chain in the entire world. They sell burgers, they sell fries, they sell shakes, and they also make money in many other ways. So that was the first question that you need to ask yourself, what exactly company do? Now, the second question you need to ask is how does company make money? So, if you look at Apple, they make money by selling their iPhones, iPad, and many other Apple products. They also make money by selling subscriptions like Apple Music and App Store. Now look into the McDonald's. They make money from their fast food business, but they also sell a lot of the land their restaurants are on and rent it to the franchisee. So that's how McDonald's make money. Now, after this question, you need to ask yourself is why might you need to invest in this company? For example, Apple is a company that people trust. They make a lot of profits every year because their products are of high quality and they're expensive. You also look into what their future plannings are. So Apple is working on future technologies like virtual reality. They're working on self-driving cars, which can even make them more valuable in future. And for the McDonald's, we can see that even during the tough times like during COVID-19, even during recession, people still buy fast food because it's cheap and it's convenient. And McDonald's has been around for decades, showing its stable company with consistent profit every year. So basically, understanding a company is all about asking the right questions. What do they sell? How do they make money? And will they keep growing in future? And according to Warren Buffett, you need to closely follow the company you're investing your hard-earned money. Now, before we talk about financials, watch this video.
You follow the company. People are concerned they haven't really introduced any new products.
Well, if you have to closely follow a company, you shouldn't own it.
Really?
No, if you buy a business, if you buy a farm, do you go up and look, every couple of weeks to see how far the corn is up, and do you worry too much about whether somebody says this is going to be a year of low prices because exports are being affected or anything like that? You buy a farm.
So as we can see that investing isn't that complicated as we think. We just want to buy good businesses that are financially stable, always play a long game. But everybody talks about great stocks. But what exactly is great stock? Now let me define you. You understand the business that well is that you're confident enough to debate with anyone about that company. And now you can sleep peacefully even if the stock drops 20 to 30%. For example, in my case, I have many Microsoft shares. Even if they drop, I sleep peacefully and I have a peace of mind that it's a great stock and it will recover in future. So great stocks are the ones you believe in so strongly that short-term dips don't scare you. Because the business is solid and the market is just being emotional. Think about Warren Buffett. During 2008 financial crisis, he didn't sell his stocks in panic because he trusted the company he owned. And that's the mindset you need. So if the stock dips, you need to think of investing more instead of panic selling it. The great stock isn't just something you hold on to when the times are tough. It's something you want more of. And when the great stock dips, it's like going on sale. For example, if you love Nike and you see their stock drops because of temporary bad news, you need to buy more instead of panic selling them. So these ideas I'm saying, they might seem straightforward, but they are hard to practice. And most people don't stick to what they know. They chase short-term trends. For example, many tech experts, they buy healthcare stocks because they heard it's the next big thing. Many people, they think to jump in cryptocurrencies without even understanding what exactly blockchain technology is. So, chasing trends might work in the short, but it rarely builds wealth over time because when the hype fades, you don't have confidence to stick around. Take Amazon, for example. It dropped more than 90% during the dot-com bubble, but those who understand the potential to dominate e-commerce, they held on to the stock and look at where it is now. So the key is patience. If you truly believe in a company, you're not investing for the next quarter, you're investing for the next decade. For example, you're a tech expert and you buy Pfizer because you heard pharmaceutical stocks are a great investment. But you need to understand that how drug approval process works, and you need to understand how patent affect revenues. And if you don't, you might panic when the stock dips, even if the company is doing just fine. Now, Apple Invest. If you use their product for years, you might already know their strengths. They have high customer loyalty. They have recurring revenue from services like iCloud and Apple Music. They're growing in new markets like India. So this makes it much more easier to hold on to the stocks during tough times because you understand why people love Apple. Now, you did all your homework and you're ready to invest. But before that, I'll teach you how you can quickly go through financial statement of the company you want to invest your money in. I personally use Yahoo Finance as it's easy to read. And there are basically three financial statements that you need to look. First is balance sheet, second is income statement, and the third is cash flow statement. The first statement we want to look at is balance sheet. And balance sheet reports company's assets and liabilities. The two main things you want to access is number one, what is company's cash position? And number two, what is their liquidity ratio? And to figure out company's cash position, you want to go to current assets and click on cash and cash equivalent. And as you can see here is that Palantir has about $3.67 billion of cash. Next, you want to find Palantir debt. And if you click on total liabilities and click on current liabilities, you will find that current debt that they have $54.18 million. Since Palantir has $3.67 billion in cash, but only $54.18 million worth of debt, that means they have enough cash to cover their next 12 months debt. And in terms of liquidity ratio, we want to find that their current ratio, which is current assets divided by current liabilities. We want to see number above 1 here. That means every dollar the company owes in short term, they have at least $1 of current asset to pay for it. And in this case of Palantir, it's actually 5.5, which is really good sign. Next, we are going to look at the income statement. The income statement shows how much money company made and how much it spent and whether they earned profit or loss. The quarter ending 30 September, we can see that Palantir made $725.52 million, and after all the expenses and cost, their net income was $143.53 million. This shows that their net profit margin is 19.8%, and it's generally considered a very good sign. And usually companies like Microsoft and Apple have their net profit margin above 20%. Now, the last statement we want to look at is cash flow statement. The purpose of cash flow statement is to know how is the company generating cash, where they are spending their cash. And ideally, you want your free cash flow to be growing year over year. And in this case of Palantir, it seems to be the case. Positive free cash flow shows that the company has cash left over after maintaining its operation and investing in its asset. But negative free cash flow isn't always a bad sign. It could mean that company is investing heavily in future growth, like research and development or new projects. Free cash flow is important to investor because it represents cash available to pay dividend, repurchase shares, and to reduce the debt. So today we explore three key financial statements: the income statement, the balance sheet, and the cash flow statement. Now that you have learned the basics, I encourage you to take a look at the financial statement of the company you are interested in. Practice identifying key metrics like revenue growth, profitability, and the cash flow. And it's one of the best way to sharpen your financial analysis skills. And if you enjoyed this video and found it helpful, please hit the like button and subscribe for more financial videos. And let me know in the comment what financial topics you want to learn about next.